Hi there, welcome back and welcome if this is your first session for today. My name is Beverly Popek. I'm with the Office of Labor Standards Enforcement, and this is our citywide and contracting labor laws webinar for nonprofit grantees. This webinar is hosted by the Office of Labor Standards Enforcement, OLSC. So this is session 6, Healthcare Security Ordinance and Military Leave Pay Protection Act. Welcome, and this is our final session for today. If you haven't joined us before, please note that we have a chat feature that you should pop open on your bottom right-hand side. Information regarding URLs and other important tidbits will be in this box as the presentation is occurring, and this will be very helpful for you so you can have the URLs. A slide deck and a recording of this webinar will be posted on our website tomorrow. So please check our website tomorrow and you can have a copy of all of the slides presenting today. If you have questions, you can ask questions in our questions and answers box. This is a feature in WebEx where you can open up on your bottom right-hand side, and we have staff providing answers to your questions during the presentation. Now, if by chance your questions are not answered during the presentation in the questions and answers box, OLSC staff will select live questions to be answered live at the end of the presentation. We will reach out to you at the email address you used to register for this webinar. So if there is an email address you'd like us to answer your question, if we have to answer it after the webinar, please give us that information with your question. And some questions may require more information, so you may be asked to contact us. So here we are. We're at session 6, Healthcare Security Ordinance and Military Leave Pay Protection Act. I'm your host, Beverly Popek. We have our presenter today, Maura Prendeville. And in the questions and answers box, we have Janet Mann, and Joyce Sorrow is returning. And she's been with me all day in the chat box. So hello, Maura.
Hi, Beverly, and welcome everybody. Thank you for joining us. I'm a compliance officer with the OLSC, and I'll be covering the Healthcare Security Ordinance. This is a law that's been around for over 15 years. It's a spending requirement. It requires that employers spend a certain amount of money on an employee healthcare, but there are different ways to comply with it. But before we get into that, I'm going to talk about who's a covered employer. For nonprofits, you have to have 50 or more people working for you to be covered by this law. Private employers are at the 20 employee threshold, but nonprofits are at 50. So if you work for a nonprofit and there are not 50 people performing work there, and you don't expect to get to 50 people anytime soon, you do not need to stay on this session or the military leave session. You're done for the day. So this is only for those kind of larger nonprofits who have 50 or more people working for them. And it does apply to city grantees. So even if you are getting grants from the city, if you are a nonprofit of this size, you are still covered by this law. And who is covered by the law once you've determined that your organization is large enough to be covered by the HCSO? Your employees that are going to be covered are those who have worked for you for at least 90 days and work an average of 8 hours a week in San Francisco. That's probably going to be nearly all of your San Francisco workforce. There are a few categories of workers that are exempt. We'll get into that later. But the best rule of thumb is to think about all of your San Francisco employees as being covered by the HCSO. And one thing that I'll repeat throughout is, like some of the other laws that were mentioned earlier this morning, we look at where the person works, not where they live. So it doesn't matter whether or not they live in San Francisco, it's where do they work. So if you have an office or a service center in San Francisco, then people who physically work there are going to be covered. If you do have any employees who work remotely from their homes and they live in San Francisco, then they would be covered too. But if you have remote employees that work outside of the city limits, they are not covered by this law because they don't work in San Francisco. So there are a few requirements. The most important one, and the one that can get employers in trouble if they don't comply with it, is the spending requirement. So every quarter, employers need to make expenditures based on the size of the company or nonprofit. So what we do is we look at the global workforce size, not just the San Francisco workforce. If you are a nonprofit that has 500 people working in Nevada and one person working in San Francisco, you'd be considered a large employer. If you are a nonprofit that has 49 employees and 49 employees in Oakland and one employee in San Francisco, you would be considered a medium-sized employer subject to the lower rate. The rates change every year. So these are the rates for 2025, and this is per hour payable. So basically what you want to do is multiply that rate that I showed you by the number of payable hours to get the quarterly spending amount. So a payable hour is any time that the employee is entitled to be paid for under state law. So that would include hours worked, sick time, vacation, PTO, overtime, any of those things are considered payable hours, but it's capped at 172 hours a month. So if you have someone who works a whole bunch of overtime in a certain quarter, you're not going to have to spend beyond that 172 per month. I have some examples here, again, based off the large or medium-sized employer rate. This is for full-time employees. So what you're looking at, if you're large, is a spend of about 660 per month or almost 2,000 in a quarter. If you are medium size, you're looking at a 440 per month spend or about 1,300 in a quarter. There are different ways to do this, and we'll talk about that later on. But if you have part-time employees, your spend is not going to be this high because they're presumably working fewer hours. If you have someone who works 20 hours a week, your spend is going to be half the amount listed here. And now how do you spend that money that you're required to spend? There are different options, and the employer has the discretion to select from among the different options. The most common way that employers comply is by paying towards health insurance. So you typically, most likely, especially if you're a larger nonprofit, you're probably offering insurance to some or all of your employees and paying towards a portion of that insurance. So any amounts that the employer spends towards health insurance premiums count as a spend under the HCSO. Employers can contribute to the SF City option, which is basically a medical reimbursement account. You may hear people refer to it as the SFMRA. That is a fund that's managed by the city's Department of Public Health. And what the employee gets from the money that you put into that account is their own individual medical reimbursement account that they can use for out-of-pocket expenses. Employer contributions to health savings account also count, as well as any other sort of irrevocable reimbursement account. Irrevocable meaning the money never reverts back to the employer. So you might have, for example, an accepted benefits account that employees can spend towards dental and vision expenses. There are different kind of private vendors out there that have that manage reimbursement accounts for employees. But employers can also do a combination of these options, and that is actually very common. So, one example is an employer may be providing health insurance for their full-time employees, but then to comply for their part-time employees or anyone else who's not eligible for their benefits, they may contribute to the SF City option for that group. Or you could even be doing both for certain groups of people. You may have people that work for you that have that are enrolled in a very expensive health insurance plan, and you know that you're already spending enough on those folks. And then you may have some employees that enroll in a much cheaper high deductible plan, and the amount the employer is spending falls short of what is required, and you may make quarterly top-off payments to the SF City option to make up for the difference. So, for example, on the previous slide, we looked at a large employer, full-time employee, the spend would be about $660 a month. If the employer is contributing $400 a month towards that person's premiums, they're going to have $260 remaining that they need to spend. So that you can do more than one thing for each employee to get to that amount that you're required to spend. The deadlines for the quarter are 30 days following the end of the quarter. There is one exception for self-funded health plans, but the employers on this webinar are probably not going to have to worry about that, so I'm not going to address that today. But the general rule is when the quarter ends, you've got 30 days to calculate everybody's payable hours and make sure that you either have already satisfied the expenditure through your insurance or made additional top-off payments to make up any difference. So the quarter one deadline for this year is actually coming up next week on the 30th, and then it's 30 days following the end of each quarter going forward. So the spend is the most important piece for compliance purposes, but there are other requirements. The employer does have to post this mandatory poster. This is the 2025 one. The poster does change each January to reflect the new rate, and this is to make your employees aware that they have a right to a healthcare expenditure. So wherever you have your other labor law posters up, make sure this is up. If you have employees that don't come to a physical work site, make sure that they are able to see this. You can send it to them electronically. You can include it in employee handbooks, but employees must be able to be aware of their rights under this law. The third obligation to maintain records, you're probably doing this anyway to comply with other state laws, but you need to keep records for a 4-year period in the event that you're audited by our office. So you'd want to keep records of employee hours, healthcare expenditures, so meaning you'd keep track of any sort of invoices that you had for insurance companies. Waiver forms, we'll get into that later, but if you have any of those, you keep record of it. And then anything else you'd need to demonstrate compliance with the ordinance if you were audited. So if you need to keep track of employees' work locations. If they're coming in and out of San Francisco, you want to know when they were in San Francisco and when they weren't. And then general payroll records showing employment dates, which you'd be required to maintain anyway. And then, of course, if you make city option contributions, you want to keep record of that as well. And then the final requirement is the annual reporting form. This is actually in process right now. So if you were covered by this law in 2024, you have until May 2nd of this year to show OLSE how you complied with the law in 2024. That we have additional resources available for employers for that. So if it's your first time having to deal with the annual reporting form, please check out this link to the additional training that we gave earlier this month on the annual reporting. And the way we communicate that reporting notice to employers is through any sort of business registration that you have with the city. So if you have not been updating your contact information on that, you want to make sure you do that so that you can get notices in a timely manner. And we also have an email list, and every employer that's of the correct size gets a notice about that every year as well. There are a few groups of employees that are exempt from the requirements of the HCSO. Again, the general rule is that almost all of your San Francisco employees are going to be covered, but there are a few who are not. Employees who are eligible for Medicare. So Medicare is a federal program designed to help people who are age 65 or older or who have disabilities, or employees who are eligible for TRICARE, which is a specific type of veteran medical benefit. Those two groups of employees are exempt from the HCSO. This is very different from employees who are on Medi-Cal, which is a state program that is intended to help lower income people get health benefits. So people who are on Medi-Cal are not exempt from this law, and people who are on different types of VA healthcare other than TRICARE are also still covered by this law. So the safest approach again is to assume that everybody is covered by the HCSO unless they're eligible for Medicare or TRICARE. This doesn't come up too often, but since this group is, there's a lot of nonprofits in this group, I will mention it. There is an exemption for nonprofit trainees. However, it's not just, this does not mean that any sort of intern is exempt. They have to be enrolled in a specific training program that provides temporary staff for nonprofit employees that helps them advance into a permanent position. And there are other requirements. It has to meet a federal definition of a nonprofit trainee, and there usually needs to be an educational institution involved as well. So if you need clarity about what this exemption means, please call our office. It's a little bit too nuanced to get into in detail here, but if you think this might apply to you, please reach out and ask, because most of the time employers misunderstand and they think people are exempt when they're not. So please reach out to us if you need more information about this exemption. Again, we rarely see it because it's a very, very narrow definition of who would meet this exemption. Another exemption is certain managerial and supervisory employees may be exempt from the law if they are earning a certain amount of money. There's two prongs to this test. So the salary amount has to be what's listed here for 2025. A lot of nonprofit salaries are not that high, so you can just disregard this if you don't have anyone on staff that makes this much. If you do, they also have to meet the definition of a managerial or supervisory employee pursuant to the HCSO. So we have a specific definition for that. You cannot assume that all highly paid employees are exempt. You also cannot assume that anybody with the word manager in their title is exempt. A lot of employers slap the word manager on a whole bunch of staffers, and they don't really have actually that much authority within the organization. So if you have somebody who manages a certain program or a certain service that your nonprofit provides, they're probably still not at the level that they would be considered exempt. So again, if you have questions about this, please call us before assuming that someone is exempt and not entitled to expenditures. And then this one, I'm only spending time on this because employers find this confusing. There are such things as voluntary waiver forms. It is a specific form that you can only find on our website. It is different from when your insurance broker says, hey, you're offering this insurance to your employees, and if they want to decline it, they can sign this opt-out form. That does not make somebody exempt from the law. They would need to fill out this specific waiver form created by OLSE voluntarily, and most employees will not want to do that because they are covered by the law if they don't sign it. The few exceptions are, or the only people that are able to fill it out and have it be valid are employees that have healthcare services from another employer. So most frequently you see an employee who declines your insurance because they get it from their spouse's job, their parents' job, if they're on the younger side, or their own second job or first primary job. So if they fit that category and they are willing to waive their right to an SFMRA payment or whatever else you would be doing for them otherwise, then you can have them sign it. Like I said, very few employees choose to, because even if they have insurance from another source, they're still covered by the HCSO. And I'm probably going to rehash that a bunch of times throughout this presentation. Employees who are on Medi-Cal or who buy their own insurance through Covered California, they do not have insurance from another employer. So they cannot sign a waiver. You need to make expenditures for those people. And waivers, when they are signed, they're only good for up to 1 year. and the employee can revoke it at any time. So they may say, oh, I didn't realize I could get MRA payments even though I have insurance, so I'd like to revoke my signature. They're well within their rights to do that. And again, so waivers are the exception, not the rule. And we see a lot of employers say things like, oh, I thought the HCSO required that we get these forms signed. No, the HCSO requires that you spend money and make healthcare expenditures for all your San Francisco employees. We would expect that in any large workforce, there may be a handful of people who have insurance from another employer and are willing to sign away their rights under the HCSO, a handful. So the purpose of the law is not to go around getting forms signed. It is what you want these forms for is if you're not making expenditures for somebody and you get audited, you want to show that you had a valid reason to not be making expenditures. I'm going to go over some common compliance issues that we see and that we hear about a lot on our hotline. Failing to make healthcare expenditures because they didn't realize that this law existed, or they didn't realize they were large enough for it to kick in. Spending too little on health insurance. So a lot of employers think, oh, I've been complying with the Affordable Care Act and offering insurance. Isn't that enough? No, it's the amount the insurance costs that the HCSO looks at. So you could be providing insurance for everybody, but if you're spending $300 a month, you're not going to be compliant because you're not spending enough. Forgetting part-time workers or other people who are not benefits eligible, even if they're not benefits eligible according to your own internal rules, as long as they work 8 hours a week in San Francisco, they're still covered by the HCSO. So being non-benefits eligible is not a reason to not spend money on them. Assuming employees are exempt when they are not. So again, we hear employers say, oh, I thought that they were exempt because they're a manager. And we say, no, being a kitchen manager at a restaurant is not going to be that's not going to be qualified as a managerial employee, or being a program manager at a nonprofit does not necessarily mean that you're exempt from the HCSO. Assuming that employees who are on Medi-Cal are exempt from the HCSO, that's another common one that we see. And this one, again, failing to make healthcare expenditures for employees who have other insurance. That's a big compliance issue. Even you don't need to worry about their insurance status. If they've worked for you for 90 days and they work 8 hours a week, they are covered by the HCSO. If they have insurance elsewhere and they decline what you've offered them, then you need to find another way to make a spend. Surcharges, I don't think this happens too much in the nonprofit world, but that's if you see an employer might increase the prices on customers for purposes of complying with this ordinance, and then they don't actually spend the money on healthcare benefits. But that's unlikely with this group. Consequences of violations. So yes, nonprofits, as well as any other employer, can face enforcement actions such as audits and have assessments of restitution, interest, and penalties. We do have admin hearings, court actions. However, our policy is that if employers come forward and realize that they have made a mistake and they want to address it, we have a process in place where they can do that. So we don't penalize employers who call us for guidance or who call us and say, hey, I made a mistake, I need to fix it, how do I do that? We're not going to turn around and slap you with penalties. So it's always better for you to proactively contact us if you think you have an enforcement issue, either a current or past one. Because otherwise, if we end up in an audit, you're going to have more expenses because you're going to have interest and penalties tacked on, and then maybe a burdensome audit that can take a lot of staff time. So if you think you have an issue, please contact us, and rather than hiding and waiting for us to contact you. And now I'm going to ask Janet to help me with some of the FAQs. Again, we are going to do We're going to go over some of the questions that we always get asked on the hotline. Janet's been responding to some of the questions in the Q&A box, and then we'll take some more live questions if we have time after this. But if you have any questions that don't get answered today, like Beverly said, we will respond to the email address on your registration. And we'll also have our contact information up here at the end if you have additional questions later. So, all right.
Thank you,
Thanks for your help,
Maura.
Janet.
So frequently asked question number one. So I offer health insurance to my San Francisco employee. Isn't that enough?
The answer is maybe, maybe not. Probably not. So offering insurance is not sufficient. You need to ensure that you want to look at the cost of the insurance. So how much does that insurance cost? If the employer is spending $200 or $300 a month, that's not going to be sufficient. And then also offering it alone is not sufficient. If an employee is offered it but declines, you need to make an alternate expenditure for them. So offering insurance to your employees would only be enough on its own to comply if all the employees accepted it and it was expensive enough to satisfy the HCSO spending requirement.
So do I need to make healthcare expenditures for employee who already have health insurance?
Yes. So even though, I might tell my employer, hey, I don't want your insurance because I'm on my spouse's plan, but I've worked for 90 days or more and I work at least 8 hours a week in San Francisco, I'm still covered by the law. So most employers in that situation will make the SFMRA payments for that employee. And because I have insurance from elsewhere, what I'm going to do as the employee is take that money that you put into the MRA and I'm going to use that to offset my family's own expenses. So perhaps we still pay towards the premium for my spouse's plan. I can reimburse myself for that. We still have co-pays and other expenses. We can reimburse ourselves for that. So it's quite common for employees who have insurance from elsewhere still want to utilize employer benefits that are paid through the SFMRA or through some other account.
So what do I do if I have offered insurance, the employee declines?
So most of the time, you still need to find another way to make expenditures, city option or otherwise. The exception would be if the employee has insurance from another employer and is willing to sign the HCSO waiver form. But like I said, that is a rare scenario. Most of the time, you offer the insurance, the employee declines it, you make an expenditure for them in some other way.
So what is the difference between the HCSO and the city option?
The HCSO is the law that requires employers to spend money, and our office enforces that law. But the city option is a benefit, a program that's managed by the Department of Public Health, and paying into that program is one of the ways that employers can comply with the HCSO. So the HCSO is the mandate, and the city option is one of the options available to employers to comply with the mandate.
So what is the city options and what do my employees get if I contribute to it?
Yeah, so there's a lot of misconceptions out there about what what happens to employers' money when they pay into this program, but it goes into an individual medical reimbursement account for that employee. So it's not going into some big pool. It's, hey, if I'm making a payment for Janet, Janet has her own medical reimbursement account that she can use for any out-of-pocket expenses for herself and her dependents. So a lot of employees, maybe they've got insurance coverage through their spouse, but they use their MRA payments to pay for their child's braces. That's kind of an example, but well, later in the slides, we'll have the URL to the city option and you can look at all the things that are covered by that. Employers do have a requirement if they're going to use this option, they do need to actually notify employees that they're doing this. So employees are not going to magically know that you've contributed to this benefit for them. It's up to the employer to send a notice to the employee saying, hey, the way we're complying with the city, with the HCSO for you is making city option payments for you. We've made a payment. That lets the employee know that they have funds available for them to use.
So there are two more frequently asked questions we got. So I thought I only had to worry about employees who aren't on my health plan.
No, you have to worry about all of your covered employees, meaning people who work in San Francisco 8 hours a week or more and have worked for you for 90 days. So the employees that are on your health plan are still covered by the law, and you still need to make sure that what you're spending is sufficient. So it depends on the cost of the health plan. If your health plan costs a lot and it's sufficiently expensive to comply with the HCSO on its own, then you're already compliant for that group. But just because they're enrolled in your benefits doesn't mean that you can just ignore them. You still have to satisfy the spend.
So doesn't this law only apply to people who live in San Francisco?
Nope. This is for people who work in San Francisco. So that's another common misconception. This law was not written to protect or to provide healthcare for San Francisco residents. It was written to provide healthcare for San Francisco workers. So this question keeps coming up more and more as time goes on. But when you think about remote workers, they are covered if they're working in San Francisco. So if they work from home and they live in San Francisco, they're covered. If they work from home outside of San Francisco, then they're not covered.
And other questions. Do I have to comply with HCSO for my highly paid employees?
Yep, this is not only for low-income employees or low-paid employees. This is for everybody. There is a small exemption for the people who meet the HCSO's definition of a manager or supervisor and make a certain salary. So this year it's over if they make 125,000 or more and they're a manager or supervisor, then they may be covered. Excuse me, then they may be exempt. So in the nonprofit context, you know, we might see like the executive director or CEO, whatever, that person may be exempt from the requirements, but a lot of times the lower level employees, even if they have high salaries, they're not going to be exempt.
So we have waivers question. I'm confused about the waivers. When are waivers required?
Okay, so we threw this in here. I've mentioned it a few times, but I just like to drill this in when we're doing webinars. They're not required. The HCSO requires that you spend money. If you are not going to spend money, you need to have a valid reason. And the only reason you would not be spending money would be if someone was either covered by Medicare or TRICARE, or if they have insurance from another employer and are willing to waive their rights to an alternate expenditure. As I've mentioned, very few people want to do that because there are other benefits that they're entitled to, even if they have insurance. So we would expect very few waivers in any group of employees. And it is absolutely not true that the employer needs to go around collecting waiver forms. The purpose of the law is that employers spend money. It is not just a paperwork requirement.
So lastly, where can I find all the information?
So we have all this here in the slides with links, and Joyce is dropping it in the chat as well. But we have got, you know, our office is here to help you. So even though the requirements of this law can be kind of complicated, or some areas are pretty nuanced, we are here to help. So we want you to attend our webinars. We do offer an HCSO specific webinar every month. We also have this email hotline and phone hotline so that we can answer your questions. We'd much rather answer questions than have to end up auditing an employer. So especially if you have a question like, oops, I've been mistaken about X, Y, or Z, or oops, I think I haven't complied for this group of employees. What do I do? Please reach out to us. And our website does have pretty extensive information and administrative guidance that's laid out like FAQs on certain topics, so you can find a lot of information there. And we still have time, so Janet, if there were other questions that we haven't answered, I'd be happy to take them.
Sure. So let me take a look at the Q&A. So we have the questions, when offering health benefits, what is the minimum and maximum an employer needs to offer or pay into, specifically if they are on the employer benefits?
So again, it depends on the employee's payable hours. If the person's working full-time, kind of like the maximum hours, it's not tied to a maximum amount of money, but it's tied to a maximum hours and minimum hours. So the most an employer would have to spend would be the rate, either medium or large, times 172 per month. So if you have an employee that works more than that, you don't need to spend beyond that. And the minimum spend would be tied to the baseline threshold of when an employee is covered, which is 8 hours a week in San Francisco. So basically between 8 hours a week and 172 per month times whichever rate applies to the employer. So as an example, again, for a full-time employee, so this is maximum spend. For a medium-sized nonprofit, you're looking at a spend of $440 per month. For a large employer, you're looking at a spend of $662 per month. So if you look at your premiums and determine that you're already in excess of that, then you've satisfied the spend. But if you have an employee that works 30 hours a week, your required spend is going to be less than that.
We have a questions about Medicare. So the employer, they do have some, they think there might be a Medicare employees. They want to know if they're exempt from the HCSO, and if so, what kind of documents do they need?
Anything that you have that shows the employee is Medicare eligible, most of the time you see that when you offer insurance and they decline it. A lot of times the employee will, or sometimes your insurance broker will ask that they provide a copy of their Medicare card so you can keep that in your records. If an employee signs a declination form for your insurance that indicates they have Medicare, then you can accept that as well. And you don't need to turn it into our office, you just keep it for your records in the event that you're audited. But you do want to count, I saw this come in too, even when somebody's on Medicare, they still count towards the overall company size. So when you're trying to figure out which rate applies to you, you're doing a global head count of all people that work for the organization, whether or not they're covered by the HCSO. So if you have 45 employees that work in San Francisco and an additional 10 that work in San Francisco but are Medicare eligible, you have 55 employees. You're covered by the HCSO, even though those 10 Medicare eligible employees aren't covered. You're looking at global size when you determine the rate.
So we have another waivers questions. So for the waiver, the first page explains the right. Can we provide the waiver once a year or when a new employee is being hired?
Yes, that's acceptable, and those are both very common. A lot of employers will do it during open enrollment. So if somebody declines insurance, then they may say, hey, if this person's eligible to sign a waiver, I'm going to offer it to them. But once a year would not be considered, doing it once a year during open enrollment would not be considered coercive if it's, happening across the workforce.
We have questions about, so how do we handle remote or hybrid employees with their hours?
So you want to track how many hours they're working in different locations, but at the end of the quarter, you would look at the hours that they worked inside of San Francisco and outside of San Francisco and figure out if the average in San Francisco was 8 hours a week or more. So say you have somebody who works at your Oakland location 4 days a week, and works in San Francisco 1 day a week, and it might not be every week, but regularly throughout the quarter, it averages once a week, then that person would be covered, but the expenditure they're entitled to would be quite low because it's tied to the 8 hours a week, not the 40 between Oakland and San Francisco. And then if you have hybrid employees, you're also including their payable hours for things other than work. So if they take a vacation or they're using PTO, you can prorate it. You can say, okay, well, they work in San Francisco 20% of the time. So I'm going to allocate that 20% of that vacation to the San Francisco hours and then the 80% of that vacation time to the Oakland hours. That's how you would handle non-work hours for a hybrid employee. And it may change over time. So you might have people that are coming into San Francisco more frequently for a certain project or a certain program for one quarter, and then the next quarter they're largely outside of San Francisco. Maybe they're not covered that quarter. But that's why the law allows for a 30-day period at the end of the quarter to total up everyone's hours. And that's where you would look at the location of those hours to see if they qualify.
And we do have one last questions about the annual reporting form. So are we granting any extensions after the official's deadline?
No, it's due May 2nd this year, but I will say we generally keep the link up for about an additional month after the deadline for those stragglers. And we don't automatically assess penalties for being late. Those would only be assessed if the employer were audited. So go ahead and get it in. Late is better than not at all.
I think we have include all the questions in Q&A. If we haven't been able to answer, please give us a call or email us, or we will email you back with your questions and answers.
Thanks, Janet.
Thank you.
All right, Beverly, do you want me to go into this one now? I guess I will. So I'm also going to cover the Military Leave Pay Protection Act. This is a fairly new law for OLSE, so some of you have not, maybe have not heard of this one. But before I get into it, I want to go over who's a covered employer. So it doesn't matter if you're nonprofit or private sector. It doesn't matter where the employer's headquarters is, but it applies only to employers that have a global count of 100 or more employees. So if you're on this webinar and you are not anywhere near 100 or more employees and you're not going to be anywhere near 100 or more employees in the near future, you can just sign off this doesn't apply to you, and it won't until you get much larger. So I'll save you some time with that little disclaimer. Basically everybody, all employers in San Francisco are covered if they're within the geographic boundaries and they're not a government entity. The basics of what an employer has to do is provide notice of the employee's rights. And we'll go over all this later on, pay supplemental compensation. And the purpose of the law, a lot of people don't realize this, but you may have employees that work for your organization, but they also happen to be in the reserves or in the National Guard. Sometimes they have had other forms of military service and they keep doing this when they come back. Federal law already provides for job protection for those employees. So the local ordinance does not touch job protection because that's already covered. But you may have employees that are in the reserves or National Guard, and they have to take time off of their day job or their civilian job to attend trainings or to respond to a natural disaster or other emergencies. So, depending on what branch of the military they're in, they may have to respond to natural disasters, civil unrest, protect capitals. Sometimes they're sent overseas. There's any reason, there's a variety of reasons that somebody could be called away from their regular job to fulfill their service with the military. But a lot of people don't realize that they usually have a loss in income when they do that, because although they do get some compensation from the military for this service, it's usually a lot less than what they would receive from their regular job. So not only are they taking time off work, but they're also suffering a loss of income. And this local ordinance was designed to avoid that loss of income. It's kind of similar to the paid parental leave ordinance that we talked about earlier in the day. There's some similarities between the two, but basically you don't need, the employee doesn't need to worry about losing their job because they're already protected under federal law. But if they work in San Francisco, they shouldn't have to suffer a loss of income because the employer will top off their military pay. So which employees are covered? This is the broadest definition out of all the laws that OLSC enforces, but anyone who works in San Francisco. So they could work for you for one day, they're still covered. There's no requirement about them working a certain number of hours. So they could just be a sporadic employee, they could be brand new, they're still going to be covered by the law as long as they are a member of the National Guard, Armed Forces, any other sort of military service organization of the United States. So even though only large employers are covered, if you're 100 or more people worldwide, then anybody that you have in San Francisco who's a member of the military is covered by this law. What that means is that while they're out on their military leave, you need to top off their pay. So you have whatever they're getting from the military, you've got what their normal pay is, and the employer will pay the difference for up to 30 days. So if you have someone who normally makes $4,000 a month, they're gone for 30 days, you verify that they're getting $2,400 for their military service, you would pay the $1,600 difference so that that person is getting their full pay while they're gone. So some calculation things that can be funky, in that last slide, that was an example that's pretty easy. But what you want to do is make sure that the employee is walking away with the amount that they would have received had they worked their regular schedule. If you have someone who doesn't work a regular schedule, we see this a lot with, for example, per diem nurses. A lot of those tend to be, or per diem medical staff tend to be, maybe have a military background and are still in the reserves, and maybe they work a very irregular schedule for you. What you want to do is look at the look back period. So you would look at most likely the 6 pay periods leading up to the leave, and use that to average what their gross pay would normally be. One thing to keep in mind is that you don't need to pay for days that the employee would not have been working for you or would not have been working in San Francisco. So, for example, if you have an employee that works 9 to 5, Monday through Friday, and they tell you, hey, I've got to go do a Army Reserve training on Saturday and Sunday, you don't have to pay them because they wouldn't work for you on Saturday and Sunday. But if the employee says, hey, I need to take off, I've got a reserve training from Saturday through Wednesday, you would top off the payments for the days when they would have been scheduled to work in San Francisco. This question can be tricky. So it's all based, the employer's obligation is tied to the amount the employee is receiving from the military. Sometimes that can be a little bit hard to ascertain, especially if the person is called out with little to no notice, because the pay they're getting can depend on which branch of the military they're in, what their rank is. Sometimes the employee doesn't know what their pay is going to be right up front. So what we recommend is that you just work with the employee to figure out how much they think they're going to get paid. Sometimes they get a wage statement. Sometimes their military orders can show the pay. But if you can't confirm it in advance, you can kind of make a best guess. I see that we have a rate chart that is supposed to go to the Department of Defense. I will probably include that in any follow-up. If anybody needs that, please reach out to us and we can provide that. But basically, if you're having a hard time figuring out what the pay is, you can always estimate and then make adjustments in subsequent pay periods. You do want to make sure that the employee doesn't receive more compensation than they would have otherwise. So you're just trying to break even on that gross regular wages. And military leave can be taken in daily increments. So it's not always the case that you have someone who's going to be deployed for a few months. Sometimes they just say, hey, I'm supposed to respond. I'm doing, hurricane relief in another part of the country, and I'm going to be gone for 3 days, or I'm going to be gone for 5 days. That's fine. They can also be called into a training for certain days, so you can just supplement the day of pay rather than more than that. And you are responsible only for up to 30 days in a calendar year. So if you have someone that's attending, say, a National Guard training once a month for 2 days each month, you're going to cover all those days because it's going to be less than 30. However, if you have an employee who does have a military leave longer than 30 days, we had somebody who called last week who was being deployed and expected to be gone for 6 months. The employer is only required to supplement the pay for 30 days. So the employee will not have an income loss for that first 30-day period, but then she will have an income loss after that because the employer is not required to pay for more than 30 days in a calendar year. It is written as a calendar year. So if you had someone who, say, went on military leave from December through January, that would be 2 different calendar years. You would need to top off both of those months. So it's not a rolling year, it's a calendar year. The timing, employers are required to make a good faith effort to pay the supplemental compensation in line with the regular pay period. So if the employee goes on leave, next pay period, you want to do your best to top off their pay as quickly as possible. Again, like our other laws, we have a record keeping requirement. So if you get any sort of notice from the employee that they're going to go on leave, you want to keep that. You want to keep copies of their schedules and their hours so you can show that you topped off the correct amount of money, as well as any, if you got any records regarding their military pay, you want to keep track of that and keep track of everything for 4 years. And resources, like our other laws, we are here to help. We would prefer that employers call us with questions if they're not sure about something. And we do have some FAQs on our website as well, links to the poster and links to the law. And yes, I saw a question come in. Do we have a poster for this? Yes, we do. I will drop it in the Q&A and the chat. And in the meantime, I can take other questions. I don't think I saw any other questions about the HCSO. I mean, excuse me, about the MLPA other than the poster, which I will pull up.
Hey there, Maura. I don't know if there are any other questions. That was super, super clear. And I think the phrase that I learned from your 2 sessions is top off.
Yeah.
Well, I don't know if you'd like to add anything else. Otherwise, I can close up.
No, I think I'm going to drop the URL to the poster into the chat as well as the Q&A box. But it will be
Great.
accessible on our website and on the slides.
Fantastic. So folks, we're going to have our recording as well as all of the slides available tomorrow on our website. I want to give you a big thank you for staying till the end, learning about our labor requirements for City and County of San Francisco, as well as just operating the City and County of San Francisco. This can be overwhelming and complicated. We are here to help, and as you can see, we have helpful staff here just for you. So thank you to Maura, thank you to Bernice, Jade, Joyce, Bianca, and Janet, and a big thank you to Pat. And again, thank you for everyone for joining us. If you have any questions, don't hesitate to reach out to all Office of Labor Standards, and we're here to help you. Thank you so much. Bye.